There's a narrative, and it's a story that began in the first quarter of this year. It was that the economy had topped, corporate profits were ugly, and we were heading to a deep, dark, ugly place. Do you subscribe to that?
No, I don't, actually. I don't think we're headed to a deep, dark, ugly place. I think that obviously this is not a good number. It's a disappointing number. But the good news on these numbers is that they are not very good forecasters of future GDP growth. And, of course, what everybody cares about is what does this say about where we're going next year. And the reality is that if you look at past GDP numbers and you use them to forecast the future, they're not very highly correlated at all. The best predictor of where we're going in the future is actually the market. Now, obviously, we've had a rough morning, but if we look at the market over the past couple of months, that's been up and up pretty considerably. And if you use those numbers to forecast GDP, we're looking at, again, something in the order of 2.5% to 3%, which wouldn't be bad. If we got 3%, that'd be great. That would be better than we've had throughout most of the recovery. So the market tends to be looking forward. The GDP numbers, of course, are looking backward. And as a result, I would like to have seen a better number, but I'm not totally dismayed by it.
Ed, which market are you looking at? Because the Treasury curve has been saying bad things about the economy for quite a while. Are you talking about equity specifically? And to that point,
I was talking about
corporate profits telling us a story related to a downturn in the economy. Isn't that a good indicator?
Well, they are, but again, everything really should be reflected in equity prices. So the best indicator, I think, again, and this is simply based on looking at historical data, is the S&P 500. What you really want to look at is the change in the S&P 500. That's not a perfect predictor by any means, but it's the best predictor of where we're going in the future. It tends to incorporate most of the information that we have out there. And so, to the extent that there are a lot of things going on in the economy, that tends to be the best summary measure. There are, as you point out, there are lots and lots of measures that we can think about. But if I had to pick one, that would be it. And it has been up considerably. So that's really the good news.
So, Ed, to what extent does the fairly extraordinary monetary intervention skew that as an indicator, the equity markets as an indicator?
Yeah. Well, I think it skews it to some extent, but not as much as we might think. And again, the reason is that if you think about equity prices, the way most of us think about this is that's a reflection of long-term earnings, long-term future earnings. And so the rates that are most relevant there are not the short rates, but actually the longer rates. And to the extent that the Fed affects rates at all, they tend to affect them more at the short end than at the long end. So while it's certainly true that when the Fed makes noises, we see it reflected in the equity markets almost immediately, but those things, again, tend to die out over time. And so if we're looking at the kinds of movements that are going to be most influential in affecting equity markets, it tends to be the longer rates. And those have been, I mean, as you pointed out earlier, they've moved, but they're not moving as dramatically. And so I think that, if we think about that, the Fed is probably not going to have a major impact on that, no matter what they do, by the way, over the next few months.